Welcome back to Investing Talk podcast. Today, we're tackling a question a lot of you have been asking. Is Opendoor Technologies a good time to buy now? We're going to look into the latest information to help you understand this really dynamic company. And hey, before we jump in, if you find value in these explorations, please remember to subscribe, like, and maybe leave a comment. And definitely, if there's a specific company you'd like us to look into next, just let us know below. So, Opendoor. It's an interesting one, definitely a company making headlines, especially with, everything going on in the housing market. We've gathered some pretty comprehensive insights to really unpack what's happening there. Okay, let's maybe start by unpacking the fundamentals. Their recent performance.
Okay.
It looks like Opendoor has been through, well, a challenging time, but maybe some interesting shifts.
It's been quite the roller coaster for them. What's fascinating, really, is the contrast you see between their top-line revenue and their profitability. So for the full year 2024, Opendoor reported $8.0 billion in revenue.
$8 billion. Okay.
Yeah, and that sounds like a lot, but it's a huge drop from $15.6 billion in 2023.
Wow.
Mostly because of, way fewer home sales happening and those higher mortgage rates putting a squeeze on things.
That is a massive drop in revenue, but I remember seeing something about their losses. It wasn't quite what you'd expect, was it?
Exactly. That's the surprising part. While the revenue basically got cut in half, their net loss for FY 2024 actually improved. It came in at $314 million.
Okay. Improved from?
Compared to a $1.4 billion loss in FY 2023.
Billion with a B. Okay, that is a big difference.
It really is. It suggests they've put some pretty effective cost controls in place. Had to, really.
So hold on. They're selling way fewer houses, but they're losing less money on each. Or overall, how does that work?
Precisely. It's about the margin per sale improving dramatically. Their gross profit margin for FY 2024 was 7.2%.
Right.
Which is a huge turnaround from negative 0.2% in FY 2023.
Negative. So they were actually losing money just on the buying and selling itself before?
Pretty much, yeah. It means they were, on average, selling homes for less than they bought them for, before even considering other operating costs. This big improvement came from being much more disciplined about which homes they bought and getting better prices when they resold them. Smarter strategies.
Okay, that efficiency is key. But here's where it gets really interesting for a company like this. What about their cash situation? And debt, that's always crucial.
Good question. As of the end of 2024, December 31st, Opendoor had about $1.805 billion in cash and short-term investments.
Okay, down a bit.
Slightly down, yeah, from $1.18 billion at the end of 2023. And total long-term debt was around $1.3 billion. Now, most of that debt, importantly, is tied to non-recourse asset-backed borrowing, basically loans secured by the houses they own.
Ah, so the houses themselves are the collateral, not the whole company necessarily.
Generally, yes. It limits the lender's recourse if things go south on specific properties.
Yeah.
But it still ties their financing directly to their inventory.
And cash flow. That's often the real health indicator, right? Especially after that revenue dive.
Well, this is another surprising positive, actually. It raises an important point about their operational efficiency. They managed to generate positive operating cash flow of $193 million for FY 2024.
Positive. After losing money the year before.
Exactly. A huge turnaround from a negative $543 million in FY 2023.
How'd they swing that?
Mostly driven by buying fewer homes, lower inventory purchases, and selling the homes they did have faster. Better working capital management, basically.
Okay, so what does this all mean for their liquidity then? Are they safe for a while?
It seems they have adequate liquidity for at least the next 12 months. So near-term operations look funded. However, and this is a however a gaver, they remain really reliant on that external inventory financing, those credit lines.
Right.
If lending conditions tighten up significantly, that could really pose a risk to their ability to buy homes and keep the engine running.
Okay, so the financials show some, let's say, stabilization after a rough patch. Looking beyond the numbers now, how does Opendoor stack up against its competitors? They're still the biggest pure-play iBuyer, right?
That's right. They are the largest, focused solely on that iBuying model. They leverage their scale, their own proprietary pricing algorithms as kind of their secret sauce, and the digital platform to make it all smooth. But yeah, the competition, even with Zillow offers and Redfin now scaling back or changing models, it's still intense.
How so? Who are the main threats now?
Well, you still have some iBuying activity, but also traditional brokerages are really stepping up their tech game. They're offering more convenient, tech-enabled services themselves.
So what really sets Opendoor apart now? Or maybe where are their advantages being chipped away?
Their key differentiation has always been that speed, the certainty of the transaction for the seller, and just the ease of the user experience online.
Like sell your house in days, not months.
Exactly. But those advantages are, eroding somewhat. Price transparency is way up across the market. Everyone can see comps easily now. And traditional agents are adopting similar tools, offering virtual tours, digital closings.
So the tech gap is closing.
It seems to be, yeah. Opendoor's high operational leverage and their local market knowledge do create some barriers to entry. It's not easy to just replicate what they do at scale, but the business is just incredibly sensitive to housing cycles. It cuts both ways.
Right. Leverage works wonders on the way up.
And hurts badly on the way down if you're caught holding inventory bought at peak prices. We saw what happened with Zillow trying this. Opendoor has managed to navigate it so far, but it's a constant balancing act.
Okay, so a tough competitive space, very cycle sensitive. Let's switch to the technical side, the stock price itself. How's that been behaving recently? There was some pretty sharp movement, wasn't there?
Yeah, definitely some notable movement very recently. As of, September 12th, 2025, the stock price reported was $9.07.
907. Okay, and where was it before that?
Well, that's the thing. It's quite a jump. For the 3 months prior, it was basically trading in a range between roughly $4 and $6.25. In fact, just 2 days earlier, on September 10th, it closed at $5.86.
Wow, okay, so a leap from under $6 to over $9 in just a couple of days. That's significant.
Very significant. Suggests a sudden surge in interest or maybe reaction to some news.
So for investors looking at the chart, what about key support and resistance levels? Where should people be watching?
Based on that prior trading, key support seemed to be established around that $4 to $4.35 level. We saw multiple bounces there back in July and August 2025.
Okay, a floor around $4.
Yeah, seemingly. And major resistance was clearly around $6 to $6.25. That's where previous rallies kind of ran out of steam. So the current price near $9.07 obviously indicates a breakout above that prior resistance.
But it happened really fast.
Exactly. You need to be mindful of how quickly it moved and whether it can hold these new levels. Context is important.
And what were the technical indicators telling us before this big jump? What was the trend looking like?
Well, leading up to the surge, the stock had been sort of oscillating around its 50-day moving average, and generally it was trading below the longer-term 200-day moving average.
We usually mean
Typically indicates more of a sideways, maybe slightly bearish intermediate trend, nothing strongly bullish. So this recent surge above both those averages, well, it definitely requires a reevaluation, but we need to see if it holds.
Any other indicators? Like RSI?
Yeah, the 14-day RSI, the Relative Strength Index. It had been hovering mostly between 45 and 55.
so kind of neutral territory,
Pretty much.
right?
Suggesting it wasn't really overbought or oversold, just balanced, consolidating maybe. Volatility, though, has remained high. Very sensitive to mortgage rate news and just Opendoor's own operational leverage.
Okay, so the chart shows recent excitement, but maybe not a long-term bullish trend yet. Let's switch gears to recent news and how the market, analysts and insiders are feeling. Any significant leadership changes or insider activity?
Yes, actually. On the leadership front, September 2nd, 2025, Shrisha Radhakrishna was appointed president and also interim principal executive officer. Came with a raise and bonus opportunity, too, which signals the board really wants to keep key leaders in place during this period.
Stability is good. Any insider buying or selling?
Interestingly, yes. That same executive, Radhakrishna, bought 30,000 shares personally back on August 28, 2025. The prices were around $4.27 and $4.42.
Ah, okay. So management putting their own cash in near those support levels we talked about, that's usually seen as a positive sign, right? Confidence.
It often is, yes. Can be interpreted that way. Skin in the game.
But I thought I also saw something about a planned share sale. Seems a bit contradictory.
You're right, there was that too. Opendoor filed for a proposed secondary sale. About 7 million shares worth roughly $35 million, plus another smaller block of 700,000 shares. Now, the company did note that the sellers denied knowing about any adverse, undisclosed information.
Okay, but still, large holders selling.
It can sometimes weigh on sentiment, yeah.
Yeah.
Even with the disclaimers. It raises questions about perceived upside, perhaps. This, combined with analyst views, gives us a picture.
So what is the general analyst view right now? Are they buying into this recent rally?
Not overwhelmingly. The consensus as of September 2025 is still kind of hold or even underperform. Many analysts actually lowered their price targets after the Q2 2025 results came out.
Why was that?
Reflecting those persistent challenges in the housing sector and just ongoing doubts about getting to consistent profitability quickly, Social media sentiment is also pretty muted, maybe leaning negative. Lots of focus on liquidity risks, macro headwinds, though you do see some chatter, some optimism after that insider buy.
Okay, so analysts are cautious. But operationally, were there bright spots in those recent results? You mentioned the loss improved.
Definitely. That Q2 2025 report, despite cautious analysts, had some real operational positives.
Yeah.
The net loss was $29 million. Still a loss, but way better than the $92 million loss in Q2 the previous year.
Significant improvement year over year.
Right. And gross profit hit $128 million with an 8.2% margin. Shows that focus on efficiency is paying off quarter to quarter, too. Their inventory also dropped to $1.5 billion, about 4,500 homes. That indicates better risk management, selling homes faster.
And didn't they have an issue with their stock price, like staying listed?
Ah, yes. Good point. They successfully regained Nasdaq compliance back in July. They managed to keep the closing bid price above $1 for the required period. As a result, they canceled a planned reverse stock split.
Which is generally good news, right? Reverse splits are often seen negatively.
Exactly. Avoided that perception issue, which helps investor confidence.
So, okay, clear operational progress despite the headwinds. Looking forward now, what are the key events or things investors should be watching for?
Well, short term, the big one is the Q3 2025 earnings release. That's scheduled for November 7th, 2025.
What will people be looking for there?
Really watching that inventory velocity. How fast are they turning over homes? And are those gross margins holding up or even improving? Consistency is key now. And of course, any major moves in mortgage rates or big U.S. housing data reports, those will impact Opendoor's stock pretty quickly.
Always sensitive to the macro picture. Are there any broader market things, maybe catalysts or even rumors floating around?
There are a few things on the horizon. ETF rebalancing happens in October, which can sometimes cause, unusual buying or selling pressure just based on index changes.
Right, forced moves.
Yeah. And then in November, sometimes you see what's called an institutional buy window open up, where big funds might reevaluate positions. If Q3 earnings impress, that could be a factor. Longer term, the big catalyst would be achieving sustained positive net income, or maybe a big drop in inventory write-downs. That could lead analysts to re-rate the stock.
And on the macro side?
Big shifts, like the Fed actually starting to cut rates or a clear rebound in housing demand, that would provide a major cyclical tailwind. There are also always rumors, things like a potential partnership with a big national home builder, maybe enhancements to their tech using more AI for pricing, or whispers of big institutions waiting to invest if earnings confirm the turnaround. Pure speculation, though.
Lots of ifs and maybes there. Okay, we have covered a ton of ground. Financials, competition, charts, news, catalysts. Given all this, let's distill it down. What are the primary risks that Opendoor investors really need to keep front of mind?
This really brings up that core question, balancing the opportunity against the risks. And the risks are significant. Number one is just that extreme sensitivity to the housing market itself. Mortgage rates going up, home prices potentially falling, those could hurt badly. And specifically, the risk of more write-downs on the homes they currently own if the market softens further.
That inventory risk is always there, and on the operational or financial structure side.
Yeah, that dependence we talked about on their warehouse lines, their credit facilities to buy inventory, access to capital is crucial. If that dries up or gets way more expensive, it's a major problem. And then just broader market risks. General economic volatility, the intense competition we discussed, and always the potential need for them to raise more capital down the line.
Which means dilution risk for current shareholders.
Exactly. Your slice of the pie gets smaller.
So let's try to bring it all together. What's the overall investment thesis summary for Opendoor right now? Where does it stand?
Okay, synthesizing all that, the overall rating, based on this analysis, lands at a 4 out of 10.
4 out of 10. So below average, why?
Well, fundamentally, Opendoor is still unprofitable.
Yeah.
And it's operating in a really tough cyclical business that's highly leveraged to housing volumes and price, things largely outside its control. Now, yes, there's been clear improvement in margins and cash flow in 2024. That shows effective cost control, some real damage limitation compared to 2023.
But
core, sustainable profitability and consistent growth, that's still unproven. They haven't shown they can make money reliably through a full cycle yet.
and the technical picture, especially with that recent spike, does that change the thesis much?
Not fundamentally, no. The technical setup before that spike was pretty neutral, maybe even leaning weak. It lacked clear, sustained momentum. That makes the stock vulnerable to sector news, headlines, macro data. That recent jump looks more like a short-term reaction than a confirmed trend change yet. And while that insider buying is a small positive, you have to weigh it against those planned secondary share sales and the generally muted analyst sentiment. It feels like near-term upside might be capped.
So boiling it down for different types of investors, who might consider this and who should probably stay away for now?
Yeah, it depends on your risk tolerance and time frame. For very short-term traders, maybe. It might offer tactical swing trading opportunities, playing the volatility around earnings or big news, but only for those really comfortable with high risk. But for longer-term investment, based on everything now, it doesn't look particularly compelling at this stage. Not without clearer, sustained evidence of a return to actual profitability or a really significant durable recovery in the housing sector itself. Investing in Opendoor right now is basically a bet on both the housing market turning favorable and the company executing flawlessly within that market. And that's still a pretty speculative bet.
Well, that was certainly a thorough look into Opendoor Technologies. It's really clear that, yes, while the company has definitely shown some grit, improved cost control, better margins, it's still navigating a very, very sensitive and competitive market.
Absolutely. Understanding that complex interplay between the macro market conditions, their own operational efficiency, and how investors feel about it all, that's critical here. And that recent stock price jump just adds another layer of complexity, doesn't it? Makes it one to watch for sure, but with eyes wide open to the risks involved.
So what does this mean for you, the listener? I think it really highlights how important it is to look beyond just one or two flashy numbers, like a sudden stock pop or improved margins in one quarter. You have to dig deeper, understand the whole picture, the good, the definitely challenging, and the, well, speculative parts. And maybe a final thought to leave you with, given Opendoor's huge dependence on the housing market, how confident are you feeling about the direction of real estate and mortgage rates over the next couple of years? Your own answer to that macro question might be the biggest factor in deciding if Opendoor deserves more of your research time. Thank you for joining us on this exploration of Opendoor. Keep those questions and company suggestions coming, and we'll see you next time on Investing Talk Podcast.